Hello traders, Andrew Curry here. If you haven't already done so, check out my website, link in the description below, where you can sign up to my free trading newsletter. For this video, I'm going to share a clip from a recent webinar I held whereby traders discussed the problems they have with actually pushing the button to execute the trade and what they can do about it. Enjoy. The type of trader I'm describing who's going to go down that route of saying, "Oh no, it's the big boys' fault. It's the big institution traders. They stack the odds against me, and that's why I think." Some people are saying that because they haven't really learned much of trading. They haven't really tried. They've come in with a get-rich-quick attitude, and when they fail, they want to blame someone else. I'm not saying that to you, Thong. I don't think it is. I don't think anybody in here has demonstrated that. But some people will say that. They're not wrong, but I don't think some of them are saying it because they genuinely think the odds are stacked in their favor. There are some people who are saying it because they just don't want to take responsibility for the fact that they didn't succeed at this, and they didn't succeed because they didn't put much work in. There are others, though. It is true that sometimes big institutions will buy or sell and use their selling power and buying power to move the market slightly, because they can buy and sell in such quantities that in the short term they can move the price, and they can move the price to where they think a lot of traders will have placed a stop loss. So we're getting really technical into it, right? But these techniques that successful retail traders are going to use, right? I'll just clear off my marks. Okay, so these techniques are common techniques that are out there, right? Like I say, some traders are just trading anything. There's not really a structure to the trading. But the ones who are having success at this have a structured approach. And they're using common strategies like trend continuation trading, or they're trading Gartley patterns or something like that, or BAT patterns, common patterns. And the big boys, the big institutional traders, they know about these strategies. They know the logic of, if it goes past here, then I'm no longer in this case, bearish trend, and therefore it's invalid. So they know that this is a logical place to put a stop loss. So what if I told you that when people are saying the big boys have all the advantages, what if I was to invert that and say, no, actually, I don't think that's true. I think us as the lone retail trader, us, plural, lone, doesn't work yet, but we as individual traders have advantages that they don't have. And you think, well, how's that? Well, that doesn't make any sense. Well, hang on a minute. We can have the price. Look at this here. We can have the price enter here and say, right, when it enters here, we're going to sell. When we press that sell order, right, whether we press it manually or we set an order in advance, would probably be a better way to do it if we knew exactly where we were going to sell. Price hits this point, the computer will do the ordering. Sell, and we can preset the stop position and the target position, and we can let it run. Right, which is good from a psychological point of view, because you can just set it and forget it, come back later. Either the trade was one of those losers or one of those winners. We can do that because we're trading relatively small amounts. Even people with several million in the bank can still have these advantages, because for every seller, if we want to sell, there must be a buyer. The trading amounts that us as retail traders do, we can exchange our positions relatively quickly. When you're trading the huge amounts that big hedge funds and banks and so forth have under management, it becomes difficult to get the trade filled in time, because if you're going to sell, you need so many buyers. So there isn't the liquidity there for them to execute these smaller short-term moves. We can enter there, get out there, and jobs are good. They can't do that. They have to scale in and out of positions because they don't have the liquidity available to change the massive quantities that they are going to have under management. If they want to enter for whatever reason, they need to find enough buyers if they're selling, or sellers if they're buying. They need to find enough people willing to exchange with them. if the price is here, they could buy enough to push the market up a few pips, where all of a sudden a lot of people have put stop losses. So there's a lot of people who will now exchange currency. In other words, this is a point to expect liquidity. And so as a result, they can push the market up a little bit. It might be considered a dirty trick. It depends on your opinion, right? Because now there's the liquidity. It's a logical place to put stop losses because they know these techniques. And so that's why you get these situations where you see a spike up past the previous high point where we've had our stop loss. So the way we get around that is, as I was describing earlier, it has a double feature. We put our stop a little bit above it with an ATR. Just above it, we escape a lot of that.